Hey, welcome back. Happy Thursday. The markets are continuing to rebound here again this week. Jobs numbers were saved by the non-farm payroll, so we'll break that down. And our question of the week this week is all about debt levels and any concerns on the debt side of the equation. Hopefully everyone's doing well and enjoying this little bit of nicer weather we've had out here in the Pacific Northwest. My name is Brandon Steele. I am a financial advisor with Mainsail Financial Group just here in Bellevue. And my goal every week is to bring to you the market data, the trends that we're watching, and hopefully weed out a bit of the noise. So I want to start on probably the biggest topic, which is jobs. Last week, for those who follow us, you will have remembered that we went over the ADP employment report that came out on Wednesday, and it was a terrible, terrible number. It actually showed that we had cut just over 300,000 jobs in the month of January. This number is not the one to necessarily hang your hat on, but it can be a glimpse of what's to come with non-farm payrolls. So we were a bit concerned, let's say, watching very carefully what came out on Friday, which is where we want to kind of pick up our conversation today. So on Friday of last week, we had non-farm payrolls numbers come out, and we showed 467,000 jobs added in January. Good news here, right? Again, this was a big concern from Wednesday. We were worried a little bit about what we may see on January. In fact, the expectations for the non-farm payrolls number was actually about 150,000 expected. So it's great to see this number increase. And on top of that, average hourly earnings were up as well. Now, that said, a lot of these numbers can be looked at as very, very positive on the surface, but I will share that although it's great to see average hourly earnings coming up, the truth is with inflation, we're not necessarily keeping up. And so it's good to see that at least wages are growing, but with the significant increase in prices we've seen over the past year or so, we're still not necessarily in the green on that. And so that will be very important to watch, obviously, in the months, years to come, to make sure that we don't hit this period where we have these higher prices, but we can't really afford them, right? That's really where part of that challenge can come with inflation. But it was great to see this number nonetheless. Non-farm payrolls, again, 467,000 jobs added in January, which is just amazing. One of the things that did come down a little bit was the hours worked, though, which I think is important, because if we add jobs, but people are working less hours, as a whole, right, if you look at the bigger picture, it's not quite the same as to say we added jobs plus everybody was working the same number of hours each week. Does that make sense? Like, you multiply those two numbers together and you're going to get the total productivity, maybe is a good way to look at it, of the country. Whereas if we drop one of those figures, but the other increases, they may either offset or not be as impactful. So again, great number on the surface. I think what this also kind of leads to is a conversation around the Fed, because as you know very well, over the last 2 weeks, that has been a huge focus of what is the Fed going to do? Are we going to raise rates? What is that going to look like? And I will say that showing that the jobs numbers are coming in strong, the Fed is probably looking at this as a signal that it will be okay to raise rates. Now, again, they may be looking at more of that minutia that I've kind of mentioned just a minute ago. But on the surface anyways, if we are adding these jobs market is growing on top of obviously the economy and everything else going on. It's a sign that the Fed may certainly be more inclined to raise rates when the time comes, maybe in March, right? So we'll be watching that very closely. We want to spend most of our time here today on jobs data, but next week we're going to spend a ton of time on inflation. We've got all the inflation data coming out. On top of that, we also have producer price index coming out, sales for the country, and then also the Fed minutes coming out next Wednesday. So we're going to have a lot to cover next week as well. And with that, we'll kind of transition to our question of the week, which I think is very relevant, actually, especially as we start talking about inflation next week. And we start talking about sales numbers, which is basically a lot of folks have seen household debt, growing. And the question is that a concern? So in other words, me or you, our levels of debt as a national average have been increasing over the past year or so. And the question is that concerning? Is that not something to worry about? And my short answer to that is that it's not as concerning as it may seem on the surface. Part of the reason for that is everything we kind of just talked about a minute ago. With inflation and hourly wages increasing, the level of debt can naturally rise along with that, right? So that's part of the equation. The other part is that assets are also at an all-time high as well. So, I think it's funny when we hear these stories, they're always tend to be looked at from just like one particular viewpoint without actually stepping back and saying, well, what's the other end of this equation? And if we talk about debt, how the heck can we talk about debt without also talking about assets, right? So when you look at those numbers as a whole, it's actually as a percentage less than it's been because our assets as a national average have increased significantly as well, right? On top of that, this is a little bit more, I don't know, maybe less of a particular point to this, but it is important, is that the cost of that debt is also much lower as well. So not only are our earnings higher to pay the debt, but second off, with interest rates as low as they are today, especially for the folks who have fixed income or fixed interest, a lot of that debt that we're paying off, even if it is at a higher level, the actual cost to service it or pay it off is actually not that high potentially. So those three things in combination, I think, is a very important kind of holistic way to look at this. Rather than looking at debt in itself, let's also look at our income. Let's also look at our assets, and let's look at what it costs to actually pay that debt, right? So those three things in combination is why I'm not super concerned about the debt levels. Obviously, it's something to watch, and especially as interest rates tick up, we want to make sure that, if all of a sudden, instead of going from 3%, people are paying maybe 6%, that is a much higher cost to pay that debt. So that's where things can become important. But again, for now, and especially with the asset levels increasing along the way, the household debt is not necessarily a concern as it stands today for us. So I hope that helps. We look forward to seeing you next Thursday at 3 p.m. We're going to talk all about inflation as well as the Fed minutes coming out next week. So definitely join us next Thursday at 3 and let me know if you have any questions on your mind. I would be more than happy to try and help answer them in our question of the week. Have a great day. We'll see you next Thursday.